There are three main aspects that create a profitable trader. Number one is their ability to handle their emotions, otherwise known as trading psychology. Number two is their ability to handle risk, otherwise known as risk management. And number three, last but certainly not least, is their ability to create a strategy that fits their trading style, but most importantly, creates a money-making edge over the market. Mastering all three of these nearly guarantees that you will be a profitable trader, but missing even one of them can nearly guarantee the opposite. So in today's video, I'll be teaching you my exact process of building profitable trading strategies, all the way from concept to creation of the strategy to testing and even optimizing that trading strategy. And by the time you come away from this video, you will have the capability to create your own profitable trading strategy yourself. So if you're someone interested in creating your own strategy or even optimizing a strategy you've learned from someone else, this video is for you. Go ahead and click that like button for me. Go ahead and subscribe if you are new, and I'll see you right after the intro and disclaimer. Yes, I noticed that in that intro, my necklace was sitting on my shirt like this, and it bothered me too, so she's getting tucked for the rest of the video. But let's go ahead and get started with the video. So the first step of creating a trading strategy is to understand the concept of the trading strategy you're going to create. And there are two major concepts that 90% of trading strategies fall into. These two concepts are very simple. The first one is a trend continuation concept. This is exactly what it sounds like. It's any strategy that attempts to follow the trend. So that would be things like a pullback strategy where you try to capture the bottom of a pullback. It would be things like a breakout strategy where you're still trying to capture the continuation of that trend. That's concept number one. Concept number two is the counter trend and or reversal concept. This is exactly what it sounds like. This is when you're looking for a market that's trending in a certain direction, like this uptrend, and then loses momentum. And with this concept, you're trying to capture the top of this move in order to sell in anticipation for the trend to completely reverse. Now, the reason the first step in creating a trading strategy is to understand the concept you're going to create this strategy around is because once we understand the concept of the trading strategy, we can create logical rules around that concept that can give us a profitable trading strategy. For example, if you just say, I'm a trend continuation trader, chances are you're not going to be profitable. But if you create a set of logical rules that give you an edge over the market based around trend continuation trading, then you're one step closer to having a profitable trading strategy and becoming a profitable trader utilizing trend continuation. So the first step to creating a trading strategy is to pick the concept that you want to trade based on, whether that be trend continuation or counter trend. The second step is to build the strategy using logical rules that align with whatever concept you chose and that can create an edge over the market. So this is the framework I use when building any profitable trading strategy. It is called CEST. This stands for conditions, entry, stop loss, and target. Now, in terms of conditions are just everything you need to see before you place an entry. Some examples of this would be things like trend, things like structure, support and resistance, supply and demand, order blocks, things like indicators, specific indicators going oversold or overbought or having divergence or having some type of crossover. Conditions could be chart patterns like double tops or bottoms, like a flag pattern, like a head and shoulders pattern. And another condition could be price, like an even handled number. Now, these are just the top conditions that I personally use when building strategies. There's obviously unlimited conditions that you could utilize when creating a strategy, but these are the examples of the ones I use the most. Next up is entries. After all of your conditions are met, why are you going to press the button? This is something a lot of traders have a problem with, and because of that, they're inconsistent in their trading. You need an exact reason that you press the buy button or press the sell button. So what is that reason? For me, the top ones that I use are candlestick patterns, such as engulfing, hammer, shooting star candles, breakouts, like flag patterns are just breakouts of a resistance or support level, chart patterns like double tops and double bottoms. And I rarely use this, but I have specific strategies where I utilize the RSI coming out of oversold. And once that happens, that may be my entry. So that's just to give you some examples of the things I use. Just like conditions, there are unlimited entries that you can try when creating a strategy. Next is our stop loss. Stop loss is very self-explanatory. Where am I going to get out if I'm wrong about a specific trade? And finally, our target. where am I getting out if I'm right? These two are super important. You never want to get into a trade without an idea of where you're getting out if you're wrong, because unlike popular belief that thinks professional trading means that you somehow have like a crystal ball and you can tell the future of the market, that's not true. Professional traders, even when you become a professional and a profitable trader, you will have losses. And your ability to handle those losses is extremely important. One of the best ways to ensure that you don't lose more than you're willing to on a specific trade is to set a stop loss where you know you're wrong and you want to get out of the trade. And having an idea of where you're going to get out if you're right is really important as well. So now we've covered the top 2 trading strategy concepts as well as the framework to building any profitable trading strategy. Let's move on now to building a profitable day trading strategy. So first off, the concept of the strategy you're about to learn is trend continuation. So we're looking to follow the trend with this strategy. We're also going to be utilizing 2 different time frames with this strategy, the 4-hour chart and the 15-minute chart. We're going to utilize the 4-hour chart to find our trend and the 15-minute chart to find some accurate entries. Now, let me zoom out and I'm going to give you a big picture idea of what we're trying to accomplish with this strategy. Then I'll explain to you all the tools you're going to need in order to execute this trading strategy. So first off, if we take a look at the chart, you can see that we have the 4-hour chart here and the 15-minute chart here. Well, the 4-hour chart, what we're going to pay attention to is this pullback right here. And remember, the 4-hour chart is where we're identifying trend. But on the 15-minute chart, this pullback, because the 15-minute chart is made up of a lot of candles, where the 4-hour chart isn't going to be made up of as many candles, the 15-minute chart is going to look more like the start of a downtrend. So I want to explain this so you understand that we're looking for trend on the 4-hour and we do not care what the 15-minute looks like, because during a pullback on the 4-hour, the 15-minute chart is going to be looking like a downtrend throughout that pullback. So what we're going to be doing is utilizing the trend again on the 4-hour chart to give us the bias of the direction we want to trade. Then we're going to be waiting for this pullback to start. Once that pullback starts, we're going to be dropping down to the 15-minute time frame, and we're actually going to be utilizing the RSI indicator. We're going to be waiting for oversold and then waiting for divergence along with an entry reason, which I'll be explaining in just a second. But after we get that RSI divergence and an entry reason, that is a great reason to assume that this 4-hour pullback might be over. We can get a really nice entry because we're on the 15-minute chart with a small stop loss and hopefully ride the continuation of this trend for some massive profits. First things first, let's go ahead and plot all the tools we need onto the chart. We're going to need the 50 EMA to help us identify the trend on the 4-hour chart. We're going to need the RSI indicator to help us identify oversold and overbought and also divergence. And we're going to need the ATR indicator to help with stop loss placement. So I'm going to go ahead and put all those on the screen with you. We're on a blank chart right now. I'm just going to type in EMA, slap that on the chart, the RSI, and finally the ATR indicator. I'm going to move the ATR to the top. That's just where I like to have it. And now we'll change the settings of these indicators appropriately. For the EMA, we go to inputs. We want this to be a 50-period exponential moving average. And for the RSI indicator, I actually want this to be a length of 10. I want it to move a little faster for this strategy. I also get rid of the RSI-based MA because I don't use that. But once you do that, you are all set. Now I'm going to be teaching you the full detailed rules for this trading strategy. So let's dive right in. We're going to do this in the framework that you learned earlier: conditions, entries, stops, and targets, the CEST framework. So obviously we're going to be starting with conditions. So for the conditions of this strategy, the first thing we want to do is look at the 4-hour chart. We want to make sure the 4-hour chart is trading above the 50-period exponential moving average we just plotted on the chart. That is very self-explanatory. Obviously, we want to see price above that moving average. Once we see that, we want to start to see a pullback. When we start to see a pullback, we're going to drop down to the 15-minute chart. I'll do that now. On the 15-minute chart, we want to see that the RSI goes oversold. On the RSI indicator, oversold means under 30, which is this little green line you can see down here on my chart. As you can see, RSI is in fact under 30 right now. So with that being the case, we have condition 1 met, because on the 4-hour chart, we're trading above the 50 EMA, and we have condition 2 met because the RSI is oversold. What do you think we're looking for next? That would obviously be condition number 3, which is the RSI creates divergence. To give you a little lesson on divergence, it is extremely simple. If price is making lower lows while the indicator creates a higher low, like this, higher low, lower low, that is called divergence. So if price is making lower lows and the indicator is diverging from that by making higher lows, we call that divergence. We're on the RSI indicator, so obviously we're going to be utilizing RSI divergence. And that's our last condition for this strategy. So let's push the market forward a bit. And after zooming in a bit to make this really easy for you to see, as you can see, we have price creating a low, then a lower low. And if we look down here on the RSI indicator, we have a low on the RSI followed by what? Followed by a higher low. So does that meet the criteria for bullish RSI divergence? The answer is yes. So that's our third condition. We want to see price making a lower low while the RSI indicator makes a higher low. In other words, RSI divergence. And obviously this is for a bullish entry. I didn't mention that at the beginning, but again, should be self-explanatory. So after conditions, what's next? Well, in CEST, next after conditions would be the entry reason. The entry reason in this case, very simple, a bullish engulfing candle after all of our conditions are met. So after all of our conditions are met, the entry is going to be a candle that completely engulfs the previous candle, or in other words, a green candle with a larger body than the previous red candle body. That is what's called an engulfing candle. Now, important note about this engulfing candle, it either needs to be the swing low or directly follow the swing low that was created with this divergence. I'll say that one more time. The engulfing candle either needs to be the swing low or needs to come directly after the swing low that created the divergence. What I mean by that is a situation like this would not classify as a valid entry utilizing the engulfing candle that I'm talking about. And the reason is here, does this engulfing candle, because we obviously have an engulfing candle, but is it the swing low or does it directly follow the swing low of this low? The answer is no. This is the swing low of this low. This candle comes afterwards, but is not the swing low and is not directly following it. So that's a really important part of this entry as well. And I also have a second entry that I'm going to share with you if you stay until the end and if I have time. I'm trying to make this video as short as possible, although it's really difficult to explain how to build a full trading strategy in a small amount of time. So a quick recap before we go over stops and targets. For our conditions, we want to see price trading above the 50 EMA on the 4-hour chart. We then want to see a pullback start at that point, dropping down to the 15-minute, looking at the RSI to see that it goes oversold, then looking for RSI divergence. After that, our actual entry reason. The reason I'm going to be pressing the buy button on a bullish trade is going to be based on a bullish engulfing candle. At that point, I press the buy button. Now, let's move on to stops and targets for this strategy. So for the stop loss on this strategy, we're going to take the value of the ATR indicator at the time of the entry candle, and we're going to multiply that by 2. That sounds complicated. It's not at all. The average true range is what we plotted on the chart earlier. I'll put it on top of my screen. If you look right here, you can see this number. We discount the last number. So this would be 4 pips, which means that the value of the ATR indicator when this candle was printed was 4 pips. For my stop loss, I'm just taking that, multiplying it by 2, and that's my stop loss. So in this case, 4 times 2, obviously 8 pips. Is going to be my stop loss. I'll grab a position tool. Entry would be right in there. Stop loss would be 8 pips, which puts the stop loss right here. And for a target on these examples, I'm just going to do a 1.4 to 1 reward to risk ratio. Feel free to test for whatever targets you would like to. Suggestion, I would test for targets back up at the highs that were created before the pullback on the 4-hour chart. That's one of my favorite ways to take targets, but for today's example, we're going to utilize fixed targets at a 1.4 to 1 reward to risk ratio. So one more time for our stop loss, we're taking a look at the value of this ATR indicator, which we can see right up here in the top left, and we're just multiplying that by 2. From our entry point, that is going to be our stop loss. So 8 pips from the actual entry, and now we have this entire trade set up and ready to go. Let's click play and see what happens to the market. As you can see, price quickly pushed up high enough to hit those targets. So that is a complete example of a bullish version of this trading strategy. I hope you guys have enjoyed the training so far. If you have, you would very likely enjoy being a part of the TTC Forex University. In the university, we have a full training course that goes all the way from the complete basics of Forex to extremely advanced strategies that I trade in the markets every single day. On top of that, I also send out 2 to 5 email alerts of trades I'm actually taking based on the strategies students are learning inside of the university. And on top of that, it's a mentorship program, meaning that any questions you have, you can actually ask, and it'll be me personally answering any of the questions you have about the training or about trading in general. So if that sounds at all interesting to you, go ahead and click the top link in the description or go to www.thetradingchannel.com to get all the details about the TTC Forex University. If you're not interested in that, no big deal at all. Let's move on now and take a look at a bearish example of this trading strategy. Same exact rules here. They're just flipped upside down. So on our 4-hour chart, instead of making sure price is above the 50 EMA, here on a bearish version of this trading strategy, we're making sure price is trading below the 50 EMA, which is our blue line here. After we make sure price is in fact trading below the 50 EMA, we then want to drop down to a 15-minute chart once we start to see this pullback. So let's go down to a 15-minute chart now. Here on the 15-minute chart, what do we want to see? We want to see the RSI indicator go OB or overbought. Here is the RSI indicator going overbought on this swing high. The next thing we want to see is bearish divergence, which means that we have a higher high in price like this, and the RSI creates a lower high like this. That's what we're looking for next. We're looking for that RSI divergence. Let's go ahead and see what happens if we push price forward. There we have a higher high, and after one red candle is when we can classify this as divergence. So at this point, we have a high followed by a higher high on price and a red candle, which tells us that we do in fact have RSI divergence. Bearish RSI divergence. What's next? Well, now all of our conditions are met. So the next thing we're going to look for is our entry, which in this case is a bearish engulfing candle. It is the opposite of a bullish engulfing candle, meaning in this case, we're looking for a red candle that completely engulfs the body of the previous green candle. Do we get that right here? Yes, we do. So with that being the case, we can actually go ahead and set up this trade. I'll put a short position tool on the chart. Do you remember what our stop loss was? It was 2 times the value of the ATR indicator. Right now, the ATR is 7. So with that being the case, we would have a 14 pip stop loss on this trade. And with today's targets on these examples being a 1.4 to 1 reward to risk ratio, this would be that entire trade setup. Let's now click play and see what happened. As you can see, directly after entering this trade, it did in fact push down far enough to hit targets. Before we move on to the next lesson, I want to make this very clear. These were just examples of winning trades. This strategy also has losses just like any other strategy. Trading in general is not about knowing exactly what the market's going to do next. It's about having an edge. It's about mathematics. If you have a strategy that wins over 50% of the time and you have a reward to risk ratio that averages over a 1 to 1, then you are going to be profitable in the long run. That's just how the math adds up. So keep in mind that this strategy obviously has wins, but obviously it has losses as well. Congratulations, we have now built an entire rules-based trading strategy together. But that's not the end of the work we have to do. You see, a strategy is like an idea or a theory. And just like any other idea or theory, it needs to be tested and validated to prove that it works or is likely to work in the future. Whenever you're done creating the strategy, you need to look at it like you're a mad scientist and you're just going to experiment until you find out what works. All this experimentation is called backtesting. This is the process of taking the exact rules we have created for this strategy and going through the past 100 instances that those rules occurred, that this strategy happened on a specific currency pair, and documenting those results. Documenting things like the date and time, documenting things like whether or not the trade won or lost, your reward to risk ratio, documenting all the information you want in order to validate that the idea you had or that the trading strategy you've created is in fact likely to be profitable in the future. So simply put, backtesting is just taking whatever strategy you've created and testing it through historic data in order to ensure that it's something profitable to trade with. And so now let's go over some key points of backtesting. First off, what are you going to need in order to backtest a trading strategy? Well, you're going to need some type of spreadsheet to record this data in. So for me, I like to use this one that I created. It has columns for everything that I want to record in my backtest. And along with that, it does some pretty cool automatic calculations to show me what the predicted outcome of this trading strategy may be. So if you don't have one of these, you will need a spreadsheet of some kind to keep up with this information. Now, if you want to get this one for absolutely free, we actually give it away with our free beginner course. So if you go sign up for our absolutely free beginner course, we send this to you through email so that you have it throughout your process of learning how to trade in that beginner course. So if you want this one for absolutely free, then you can go to the link in the description that's labeled free beginner course, and we'll send it directly to your inbox. So let's do one trade together just to ensure that you have a handle on this. This was the bearish example of our strategy. As you can see down here, we have our bearish divergence on the RSI. We have a higher high here, and we have our red engulfing candle covered in this green line. So if I was actually backtesting this, I would wait for this to occur. I would put a position tool on the chart. I would set my stops and targets accordingly. Then I would see how the trade played out. If the trade played out as a win, this is exactly what I would do. I would come over here to my spreadsheet. I would put in the pair, which is the dollar Canada, the time of this trade, which is 10:15, the date of this trade, which is 3/11, my stop loss on this trade, which was 14 pips, and my target, which was 20 pips. And then I would move on to the next trade. I would literally do this 100 times for the last 100 trades that happened with this exact strategy. I would record that data, and that's the process of backtesting. That's what proves to you that you're going to be trading something in live markets that is a profitable strategy and has a very high likelihood of making money in the future. Now, outside of a spreadsheet, I get a lot of questions about how to backtest something that is a multiple time frame strategy. It's actually really easy on TradingView. There's a little button, I'll try to zoom in or point it out, right up here, the square that you can see that I just put a circle around, which just seems weird. This square, if you click it, you can go and actually get this little double setup. And if you click one of them and leave it on the 15 and then click another one, you can put the other one on a 4-hour chart. And with this being the case, I now have the visuals of a 4-hour chart down here and a 15-minute chart up here. Now, something else that's really helpful is to go to these settings down here, and you want to go ahead and click crosshair for sure. You want to make sure you can see the crosshair on both of the charts. And that's what these settings are. It's syncing the layout. So this is a dual chart layout, and you want to sync it up. You want to sync it up with the time. The crosshair, you do not want to sync the time interval because we are doing separate time intervals. So that would make no sense because we're doing a 15 and a 4-hour. So you don't want that synced. And that's essentially it. And the beauty of this is it makes testing strategies with multiple time frames very easy. The bottom right now is my 4-hour chart. On the 4-hour chart, what am I trying to do? I'm trying to make sure that price is below the 50 EMA. So at this point, I can see that price is still below the 50 EMA, and I can also look up here on my top chart, which is my 15-minute chart, and on this chart, I can see that I have RSI going overbought, divergence with a higher high on price, lower high on RSI, and an entry, and I can also see that that entry was a winner. So using this multiple chart layout is how I backtest strategies that utilize multiple time frames. I feel like that may have been confusing just because you could barely see my crosshairs on the screen, so I made them a lot darker. Now you can see my crosshair on the bottom chart and on the top chart. Since I can see it on the bottom chart, I can tell when price is above the 50 EMA, like right now, and when price is below it, like way back here. So with this being the case, I really just have to pay attention to the top chart for possible trades and keep an eye out down on the bottom chart for a possible change in the trend based on the 50 EMA. To give you an example of that, I'm looking on the 15-minute up here. I can tell on the 4-hour chart that I am obviously above the 50 EMA throughout this entire section here. I'm still above the 50 EMA. I can tell that again by looking at the bottom chart on the 4-hour chart. And here, we have that RSI divergence. We have a trade right here. The reason is we have RSI divergence from the previous low to the new higher low, and we have a lower low in price. All this followed by this engulfing candle. So this is the way I would go about physically backtesting the strategy, is by utilizing the dual chart setup I showed you how to do just a second ago. And if it helps, I would make my crosshairs really dark like I have them here now. With that said, that is backtesting in a nutshell, but I'm actually going to go ahead and show you the results I got, give you an idea of what that actually looks like. Here you can see a lot of red and green vertical lines on my chart. I'm actually just going to pick one of these to get this less confusing. As you can see, all of these lines are those trades. All of these lines are the backtest I personally just did from the very beginning of 2024 to today's date. I normally utilize these green and red vertical lines, and the reason is because it shows me the date and time, which just makes it that much easier whenever I'm plugging these numbers into a spreadsheet. So I would suggest using vertical lines like this in your own testing, but throughout 2024, this strategy has performed very well here on the dollar Canada, giving 22 wins, 18 losses, which is a 55% win rate with a 1.4 to 1 target. This test was done utilizing the exact same rules you have learned throughout this video. Just wanted to give you an idea of what that looks like on a chart. And if you end up going out and testing this strategy, comment your results below to let other traders know what they can expect once they start their backtesting journey utilizing this strategy. Now, moving on to the final part of creating your very first trading strategy from scratch. The final part is the optimization process. Now, this process can be as easy or as difficult as you want it to be. Personally, I do kind of a minimal optimization process. I only optimize for 3 different things. Once I backtest a trading strategy, I normally backtest it on all the currency pairs you can see on the right side of my screen, all the way down here to the New Zealand dollar. From there up to the euro dollar, these are the currency pairs that I normally test with any strategy that I create. And the first step in my optimization process is to pick the best performing currency pairs. Now with this, I pick the top 3 to 6 performing currency pairs with that specific strategy. And those are the currency pairs that I trade with that strategy because they have historically shown to be the best performing pairs. So those are the ones I want in my arsenal for my trading strategy and in my arsenal for my full trading plan. That's the first step of optimization that I do. The second step of optimization is to find the best target for the highest ROI or win rate, depending on what you're going for. If you want a high win rate strategy, you may have to sacrifice some of your ROI, which is return on investment. Your overall, what you gain is what that is. So if you want a higher win rate, you may have to sacrifice that because you're going to have to go with a lower reward to risk ratio on your trades to get a higher win rate. But I tend to go for the best targets for the best ROI in my own optimization process. This is something you can do while backtesting as well. Optimizing and backtesting kind of go hand in hand, but I wanted to make sure that this list was as organized and as comprehensible as possible. Next up, after optimizing for the best targets, you obviously have to optimize for the times that you can trade. So you're going to look through your backtested data and make sure all the winning trades didn't happen at a time where you could not be around your computer, when you're taking your kids to school, when you're asleep. You want to make sure that you are still profitable, even when you're limited to only the time where you can be behind your computer actually trading. So this is my optimization process. Yours can be wildly different. You can make this as complicated and complex as you would like to. I just keep mine very simple by optimizing for these 3 things. If you enjoyed today's video and you're looking for a little extra help in your trading, then chances are you would benefit from becoming a student in the TTC Forex University, our mentorship program. We have some space available in that. And again, it comes with a full course going from the complete basics of Forex all the way to advanced strategies and everything in between. It also comes with 2 to 5 of my own trades that I'm taking each week, getting sent directly to your email inbox. And it is a mentorship program, meaning that I'll be there to help guide you through your process of becoming a profitable trader. So if that's something you're interested in, go ahead and click that top link in the description or go to www.thetradingchannel.com. If that's not something you're interested in, no big deal at all. Just be sure you're subscribed here. Be sure to like the video if you made it all the way to the end. Comment and say that you made it to the end, and I'll try to like every comment that says that. It's Friday, so I hope you have a great weekend. I hope you trade green next week, and I'll talk to you in the next video. See you soon.